Money is made possible by financial support from Old National Bank and Chicagoans like you. Thank you. Welcome to In the Money. I'm your host, Kimberly Loftis, a CPA and Chicago Business Journal woman of influence who is also a financial executive that is passionate about personal finance. Tonight we'll be diving deep into the world of economics. But do not fear. I promise to keep it light but informative so that it's understandable for everyone, from young people new to finance and old timers looking to grow their wealth and leave something for the next generation. In today's roller coaster economy, where ups and downs seem to be the only constant, we've all asked ourselves, how can I save more, and is my money actually growing or just taking a long nap? Well, tonight we'll answer those questions. We'll also break down savings rates, investments, and what the economy's twists and turns mean for your own pocket. To help us with these financial waters, I'm excited to have some of the brightest minds in economics and personal finance. So get ready to unlock the secrets to saving in today's economy and empower your financial future when we come back after the break. As I mentioned earlier, the economy has a big impact on our wallet, and today we have former Federal Reserve economist Emerson Douyon with us to help us understand the economy. Welcome to the show, Emerson.
It's a pleasure for me to be here with you. I watch your show, and to tell you frankly, I'm a fan of your In the Money.
Well, I am so happy to have you. So please share with our viewers what an economist does. See, I can't get the word out, but what does an economist do?
Economist is an expert. What he does is study scarcity, and he shows people where the economy is going.
Okay.
And therefore, they call it a science. But a lot of people say that it's not a science because it's not exact. We use a lot of statistics. When you use statistics, you can manipulate it and then to do exactly what you want to do with it. This is the reason why they say it's not a science. But if you want to call it a behavior science, because we know how people behave based on the pocketbook.
So I had to ask you this question. When COVID happened, we talk about behaviors. Why do people run to get toilet paper? Can economists tell me that?
Well, you know, because they say that it's, like I said, it's scarcity. They say, well, we're not going to have paper. Everybody wants to stack paper, and then therefore for the distribution, they say you can only have two. And so everybody can balance. It's the same thing with the economy.
So basically, using the toilet paper example, it was one, people saw other people going to get toilet paper and said, oh, that must be important. There was a run on toilet paper. Then the market said you can only get two at a time. And that made people want it even more because they were scared that they were going to run out of toilet paper. Exactly. That's the same thing that happens with the economy when we're talking about spending and money and things that go on.
This is exactly what happened in 1907. Big panic. People went to get their money, and then that's how Federal Reserve Bank was created. In 1913.
Now, what is the Federal Reserve Bank?
Federal Reserve Bank is a central bank of the United States. So the same way that you need a bank, Federal Reserve Bank is a bankers for bank.
Okay, so if I'm a particular bank and I want to give money or loan out money to my customers, I had to get that money from somewhere, and I might go to the Federal Reserve to get that money.
That's one thing that Federal Reserve Bank does. The Federal Reserve Bank system, what they do, they keep the checking account of the government.
Oh, okay. Now, how does the interest rates get impacted by the Federal Reserve?
They watch the economy to see if it's too hot, they cool it down.
And what does that mean, too hot?
So plus they look at the inflation.
Okay.
If the inflation is too high, they will raise the interest rate. If it's too low, they will lower it. And this way they make it, they balance it. This is what they do.
So what do we mean by inflation when you use that word?
Inflation is too much money chasing too few goods.
So that inflation drives prices up?
Exactly.
Because it goes back to that scarcity, not having, people believing there's not enough, or actually there is not enough, is that correct?
And so therefore, the Federal Reserve Bank want to keep the inflation at a certain level.
But why is inflation bad? Because for me personally, as I go to the grocery store, why do we think inflation is bad?
Because of the money, the Federal Reserve Bank cut the money supply, so money become scarce to you, so therefore you have to pay higher for it. And the same thing with mortgages. Usually when the interest go up, mortgage goes up also.
So inflation is bad because it costs me more to get the basic needs that I have. And inflation is bad because if I want a mortgage or something that I have to pay interest on, the interest rate is higher. Is that correct?
That's why, and the Federal Reserve Bank tried to keep it stable.
Now, is there anything where the inflation can be too low that's bad?
If it's too low, they will find a way to increase the inflation. They try to keep it at a certain level.
But how is it bad for me as a consumer if everything is like cheap, when the inflation is low and debt is low, my interest rate is low? Why could that be a bad thing?
Too much money in the system.
But how does that impact me if there's too much money in the system as a consumer?
It doesn't impact you, one particular person, but then the entire economy is having problems.
Okay.
Because there was what they call the strong dollar and a weak dollar.
Okay.
If it's too strong, it's going to create a problem with international trade.
So given what we've talked about interest rates, as a consumer, how can I use that information to benefit me? Like if I'm in a high interest rate environment, what should I be doing?
Usually, that's what I said at the beginning, it's a behavior. People will stack their money and say, I'm not going to spend it now, I'm going to wait until. And when that happens, you create another problem on top of the problem.
And what about when it's low? Am I just spending money instead of holding on to it when the interest rates are low?
When the interest rate is low, usually people go and then try to get mortgages. And then they keep purchasing what we call durable goods. Anything that can last more than 5 years, we call it durable good. So that's when people start buying things like that.
Now, as an individual, I understand interest rates, but what other economic indicators should I be looking at to understand what's going on with my money or what investments or things I should make? So interest rates being one, what are some of the other things out there that I should be looking at?
Most of the time it's the interest rate.
Okay.
You start to, because once you get the interest rate high, if you invest your money, it's going to be higher. And people watch S&P 500 because that's 500 major companies that trade. So this is one of the indicators, or sometimes they use it as a gauge to see exactly which direction to go.
And so that would tell me if I'm doing better with my stock portfolio in the market or worse than this index, so to speak, of S&P 500, for example.
Exactly.
And so a lot of times we want to gauge our performance against that index as an indicator that I can use as an investor.
Exactly. And usually it's average from 7 to 15%.
So if you're doing better than 15%, you're doing better than the market. Is a way to look at it.
Exactly.
If I'm doing less than 7%, I'm doing worse than the market.
Yeah.
But because some people, if you want to do better than the market, does that mean you got to take on more risk?
So it depends on where you put your money.
Okay.
Some people are risk sensitive, some are not, and there are certain things that you can do with your money where you cannot lose. It's risk free.
Mm-hmm. Like savings accounts, things like that, because they're federally insured?
Life insurance, for instance.
Okay.
And a lot of people don't like to talk about life insurance because once you say life insurance, and that's why they don't call it death insurance anymore. So, but if you have an IUL, for instance, you have a platform and a ceiling. So,
okay, so it's basically, when you're thinking about outperforming the market, there's different vehicles that can use to take on your risk tolerance.
exactly.
Well, thank you so much for the time today. When we return, we will be live in the studio with Ben Juergens, our Money Matters expert. Hi, Ben.
Hi, Kimberly. How are you?
Good. Welcome back.
It's good to be back.
Tonight, as you heard, we're discussing the economy and how that impacts wealth creation. From a financial advisor or banking relationship perspective, how can they help us in building wealth or create wealth building opportunities for our future generations?
Yes, I know, like many times when I've been here, we've talked about the importance of, savings in a bank account, that emergency savings. I think once that piece gets complete, right, we've built a cushion in that fund. Really, the way that we look at it is the investment side. Having that relationship that we've talked about with bankers, it's even more important, I think, to have that relationship with an advisor that can really make sure that we're in a pathway to help us achieve our individual goals. I mean, they're the experts. This is what they do for a living, and they can kind of understand you based on your relationship with them of where you want to take that down the road.
So based off of where their audience is in their life or their career, if I'm just out of college, is it too early to establish a banking relationship?
No, to be honest, I wish I would have started mine younger. As I speak a lot of college campuses, and many of the students are really interested in investing. And I think at that point, many of them haven't developed the many bills that we get to see as adults, right? I think the average adult has 15 to 17 bills. So for them, they can start taking money right out of that paycheck as soon as they start working and get used to that money disappearing a little bit. With the time value of money, though, that can really build that larger nest egg much quicker than if we were to start, say, in our 30s.
And what about that young family who they just had their first child or second child that are still like toddlers? What about that relationship?
Yeah, so I think there's many different ways you can look at that. From an investment side with an advisor, that young child, I remember the day my kids were born, we opened up a 529 college savings plan, right?
So do we,
and when we talk about the riskiness of the investments, when they're young, I'm open to more risk because I know they've got time to make up if something were to happen with the economy, the market. Then as they get older, you can reduce that risk and mitigate that chance of loss. But I think, I'm a big fan of starting as young as you possibly can, just because you can enjoy life better earlier than say most Americans do, to be honest.
And what about that mid-career, pre-retirement age?
Yeah, I think that's where we're really pumping the most that we can in. When you get in your prime earning years, I think this is really, whether it's in a 401k where it's working in the market, or once you've established that emergency fund and you're working with an advisor, when you're in your prime earning phase, I think that's the biggest time to really be putting as much as you possibly can. So you can really see the benefit when you have a successful market. And for me, I don't look at how my portfolio is doing unless we're at an all-time high, right? Because emotionally, people really make bad decisions when they get emotional. And I think that's where the advisor comes in. Well, they're in a neutral position where, they're not understanding all the emotions you may be going through as a new dad or whatever it might be. And that really helps control that. So when the market's doing well, then you do look at it and like, okay, I'm really on course. But when it's bad, I'm not going to look at it because I don't need that money yet.
So as we close out our topic on Money Matters, what is that one tip you would like to have the audience to feel comfortable approaching that banking relationship?
Yeah, so I think really it is talk to multiple people, right? Find somebody that you feel comfortable with. And if you're working with somebody and you feel like they might be steering you in a different way, go talk to somebody else. You want to find somebody that understands you and understands your dreams and goals. But as that beginning investor, I really think it's important to just start now. Too many people delay it. When I was at the bank at 19, when I first started, they're like, do you want to save for retirement? I'm like, I'm too young for that.
Right.
Man, I wish I could go back and talk to myself all over again. But start young, put as much as you can in early so that you can really enjoy the fruits of those labors down the road.
Thank you, Ben, for that wonderful tip. And when we come back from the break, we're going to have our next financial expert focusing on building generational wealth for the next generation.
Hi, I'm Bianca Cotton. Join me Mondays at 7 p.m. for Behind the Confident Smile as I sit in conversation with incredible, dynamic, and complex Chicagoans who peel back the layers, living lessons, the joy, and the pain behind their confident smiles. You can watch on CanTV 19, cantv.org, and CanTV Plus app.
Welcome back as we dig into building generational wealth. We first covered how the economy impacts our wallets, and now we'll focus on saving strategies with our next financial expert, Tamara Dervin. Please welcome to the show, Tamara. I'm always looking for new ways to save. Have you come across any hacks or tools that has made it easier for you to save?
I would say the best hack and to help you to stay consistent with your saving strategy is to do it automatically. So if you are working and you have an employer that allows you to break up your check and send it to multiple accounts, do that. Send your savings or even your investing, because you can actually send it to some of the brokerage houses now. Send it directly there from your paycheck. Also, some financial institutions allow you to do automatic savings from your checking account to your savings account every month or whatever frequency you want to do. So doing it automatically keeps you consistent. That's the biggest hack.
What about when I get a pay raise? What should I do?
I recommend if you get a pay raise or even a lump sum payment, like, tax season, sometimes people get tax refunds. Use those lump sum payments or even those increases to automatically save because you weren't using that increase anyway. That lump sum, use it toward, if one of your goals is to save or increase your investing, use your raise or even those lump sum payments to increase your savings or investing.
What about if I have debt? Is there a certain percentage I should put toward debt versus savings?
I would say whatever your priority is, when you sat down, at the beginning of the year and you say, okay, these are my goals. If getting rid of your debt is one of your financial goals, I would say aggressively go after your debt because debt is a detractor from you building wealth and you saving, because the debt is like a burden. It's bringing you down. Even though you're putting in savings, you still have this liability that's bringing your net worth down. So try to get rid of your debt. But if you're saying, okay, I really want to save, because you should start saving for retirement, I would say still put a percentage away for your retirement savings and making sure that you build up an emergency cushion, because you do need that because emergencies happen. And those also detract from continuously trying to build wealth. So I would say try to get rid of the debt and then aggressively go after your saving and investing strategy.
So for retirement, say I still have kids and I'm ready to retire, but I can't really say because I got to do stuff for my kids. I got to put them through college, all these different things. Should that balance be? Because I'm not going to have enough money for retirement if I also am paying for my child's education. But I'm talking about generational wealth. I don't want them to be saddled with that debt. So what are some of your recommendations?
Well, my first recommendation, like I just said with the other thing, is to sit down and prioritize. Okay, let me sit down. What are my priorities? So if you say, okay, my priority is I want to send my child to college debt-free. I would say still invest in your retirement, because at the end of the day, let's say you get to a point where you can't work, you need money to support yourself. Even if I know debt can be bad, but for your kids' education, you may be able to help them even down the line to pay off the debt. But if you're not starting as early as possible with saving and investing for your retirement, you're losing time. You're losing like the time value of money, as your previous guest stated. So I would say try to at least put some money away for your retirement and try to save for your child's retirement. I would say your child's college education. whatever you can afford to do. Sit down, do your budget, and say, okay, I can afford to put this amount of money away for my child's college education, but I also can still consistently invest on my retirement.
Now, what about just assets, just passing on assets to the future generation? Is savings accounts enough to start that? I mean, what other things should I be looking at?
I would say definitely start teaching them how to save, how to, if you do an allowance, however they get income, teach them the value and the practice. Because I think a lot of us haven't learned that practice of saving consistently. Like when we receive money, when we make money, the first thing you should do is save a portion of it. So teach them that practice early. The other thing is to build wealth. I would say start teaching your kids how to invest. And an easy way, and I did this with my son also, to teach them how to invest is teaching them the things that you love to buy or you or you see that is booming, invest in those companies. There's a great platform that allows you to show your kids, okay, let's say you like Nike. You can see who owns that, or it's a specific game you like. You can see what company actually owns that brand, and invest in those companies, because if you're using it and you know your friends are using it, it's probably a good company and it's probably been around for a long time. And there are a lot of companies now that allow the kids to invest whatever amount that they have. They can buy fractional shares in the company, and I've seen this method grow, and my son gets excited about, okay, I want to invest in whatever, Nike, Sony, Microsoft, all of those different stocks, because he knows that he buys the games, all of that. And so he's like, and he's even actually, he showed me the other day, he says, you see this stock price for, I think it might have been like Microsoft or the company who owns NBA 2K, because he likes that. He said the stock price goes up because this is when they do releases. So he's actually starting to analytically think about how stock prices work, when they go up, when they go down. So I would say a good way, not only with the saving, but teach them how to invest and get into the market to learn how to continuously build wealth.
Now, what about life insurance and investing? Like some life insurance vehicles allow you to pick investments, and then also there's some where you had to go through a brokerage account or a bank to do an investing. Is there any pros and cons of one over the other, or just it depends on your situation?
I think it depends on your situation. I would definitely, we always talk about personal finance being personal. So I would say I would talk to an advisor. A financial advisor that has a fiduciary responsibility to you. That means that they have your best interest at heart and not necessarily the interest of them just trying to get a sale from you. So talk to them about what your financial goals are and what you're looking to do, because each person's financial house is different. Their income is different. Maybe all the assets that they currently have are different. What tax advantages they're trying to receive are different. So I would say talk to a financial advisor and say, okay, based on these are my goals and this is how I want to live in retirement, what financial products are best for me in my financial house? That would be my advice in that, because I would say this, we all need life insurance, because at some point we do have to leave the earth, and you want to make sure that your family are able to not only take care of your final expenses, but also leave them something to help increase their wealth to the next generation, because a lot of times we haven't done that, but other communities have done that for years to help them to continuously build wealth.
Because I know I've been in situations where I've known people where they couldn't, the money they had set aside to do something, they had to put into the pot to help somebody to bury somebody, because that family member didn't have insurance, didn't have any assets. So how do I make sure that my family members don't end up in the same situation? Should I be having family conversations? And because, it's all about, my cousins, everybody building generational wealth.
I would say it's definitely a family conversation that needs to be had. I know it's hard because a lot of times people don't want to talk about death. They don't want to talk about leaving this earth, but we all are going to leave this earth at one point in time, and it does cost money. So we want to have that conversation about, okay, what are, not only just about the life insurance part, but also what are your wishes? Actually do like a family estate planning meeting. What are your wishes as far as, your services, like do you have life insurance? If you have it, where is it located? Sometimes not only do we not know if our family members have life insurance, we don't know where it is. We don't know what company is it. We don't know where their bank accounts are.
Right.
And as we've matured financially, a lot of us maybe have multiple accounts across everywhere, and we don't know where this is. So I think that we definitely need to have the family conversations, especially with our loved ones that are closest to us, and we know that we would have to be involved in taking care of their final arrangements. I think we definitely should sit down and have those conversations.
Well, I had a lawyer, and I was putting my living will together, and said my sister is my beneficiary, my main beneficiary outside of, my daughter, the estate, person could be over the executor of the estate. And she was saying, don't let her know, because I was like, I've never heard of that, where you're scared somebody's going to off you because the executor of the estate. I was just like,
well, I think that whoever you're selecting, you would trust that person.
So I would just put that out there for people who are just concerned about that stuff. It's like, you definitely want to get
And I guess maybe some people do have that concern, but I would hope that you would have someone in your close circle that you trust.
Oh yeah, I trust my sister.
That you could tell that they're the executor.
So I was just like, okay, but it's really important.
It's very important.
And then for those hard assets, so we talked about savings and the life insurance and having a will. What about other assets like a house?
I was just going to say that real estate, you definitely need to make sure that people know, okay, is your house paid off? Where's your deed? If your house is paid off, because the other thing is sometimes people will have these assets and they'll say, okay, I want it to go to this person, or there's a person living in the house, but there's no plan. There's no executor to say, okay, or no will or trust to say, okay, this is exactly how it's going to be transferred. People don't understand that there is a process, and then the state has to get involved to disseminate, assets to people, and that process can be long, and sometimes it can be messy depending upon what other family members you have. But that's all a part of your wealth building. Your savings, your investments, your real estate assets. Some people actually also have businesses that are thriving and profitable. Those are assets that you have that you're trying to leave to the next generation. These are all ways that you can help build wealth within your family line.
So it sounds like not only do we need to build it for the next generation, but we also got to communicate.
We have to communicate.
Well, thank you so much for coming today.
Thanks for having me.
And we'll come right back from the break.
Hello, I'm Rich Robbins, inviting you to join me for the series Soft and Tender. Soft and Tender celebrates the resilience and emotional depth of Black fatherhood, offering a powerful narrative on family bonds and ongoing challenges faced by Black communities.
As a father and as a parent in general, you have to know that you're not going to always understand, and that's okay.
Tune in on CAN TV, cable channel 19, or stream at cantv.org or the CAN TV Plus app. Experience the power of community television.
Understanding all your options for creating generational wealth is crucial in building a financial legacy that benefits your family for generations to come. Regardless of your current financial situation, it's possible to create a strategy that not only secures your future, but also ensures that your descendants have a solid foundation to build upon. This approach prevents the next generation from starting from scratch, financially speaking. It's also about building a legacy of financial literacy so your family doesn't make the same financial mistakes you made, or build on the financial lessons you taught them, which also moves the whole family forward. As you think about what we discussed today, I hope you move forward by researching and creating a savings plan based on your goals for your family. Make sure to get a deep understanding of insurance options, investing options, and savings options so that every dollar grows. Join us next week as we continue our journey to financial freedom for 2024. If you have any questions about today's topic or past topics, please send me an email to Kimberly@inthemoneyemail.com or follow me on Instagram at Diva of Cashflow. Remember, we are on this journey together.